Good afternoon, and thanks for joining us today in a discussion of a very controversial topic, investing in gold, silver, and platinum in both a volatile market and economy. The SIF marketplace has an abiding interest in the promotion of alternative investments in the retirement channel, utilizing primarily fee-based advisors and regional trust operations, with a financial wrapper bias towards daily price collective investment funds or SIFs. While we have most of the traditional style boxes available, it seems really since 2008, most of the interest in large measure centers around conservative options like stable value funds or low duration cash products, where the advisor community is looking both for options to protect their clients on the downside as well as to preserve their billable asset base. One need only turn on the radio or TV and be deluged by promotions for gold, silver, and platinum as perhaps the best performing style box since the turn of the century in order to be better informed about the interest in and the sense of urgency about these options. I have today with me two guest speakers, Mr. David Ranson, who is the President and Director of Research at H.C. Wainwright & Company Economics. David is an internationally known author and contributor to Forbes magazine as well as The Capitalist Perspective, and has appeared on a number of radio and TV shows across the country, if not across the globe. Also on our panel today is Mr. Mark Farmer, a Vice President of Business Development for Bullion Management Group out of Canada. I think you can tell which is which from the accents of each. But Mark has been traveling all over the globe spreading the word about this box area and has a number of unsettling but important comments in terms of the world's economy that I hope he'll share with us today. I'd like to advise everybody participating in the call in terms of the ground rules here. First of all, due to the volume of listeners, we'll probably first on allowing the presenters to speak, and then we'll open it up to the floor for questions, which can be submitted by each of you directly on your screen by typing in a specific question that you would like to have addressed by the panel and to whom you would like it addressed. So now at this juncture, let me turn the controls over to Mr. David Ranson for his remarks.
Yes, I hope everybody can hear me. Well, I'd like to speak about the simple economics of gold or precious metals and stagflation. And I'd like to start with the idea that stagflation is already here. Let's admit that the U.S. economy is looking less healthy all the time. In fact, it seems to be on this stagflationary path. A couple of months ago, the government revised its estimates to show that real GDP grew more slowly in the past few years than had been thought, that the recession was worse than had been thought. And the first of our exhibits on slide 3 here shows the deeper recession and also a weaker recovery. The economy has grown even slower in 2011 at an annual rate of only 0.8%. In spite of this weakness, price-sensitive goods such as food and energy have escalated. The Fed claims inflation is under control, but I think the rest of the consumer price index is untrustworthy, and there's a good deal of support for that. Certainly it looks as if we have a lot more inflation in our future than in the recent past. For early warning of inflationary pressures, you really can't do better than watch the price of gold, and that's shown in the second of my charts. Although the CPI moves slowly and smoothly over long periods of time, it does catch up with the price of gold sooner or later. And take a look at precious metals prices, including the gold price, in the next slide. You can see that precious metal prices are up six-fold in the past 10 years. And in light of that, the outlook for the cost of living is a big worry. How did we get into this mess? There's a lot of answers to that question, but here's mine. Most people realize that federal deficit spending is inflationary, and it really does push up the price of gold, as you'll see in a moment. Many also say that it's an economic stimulus, but the facts for the last 200 years, decade by decade, show otherwise. The table in this next slide shows that in fact budget deficits, except in wartime, are followed by lower growth, and a budget in surplus or balance is followed by higher growth. Another program on which Washington is intent, of course, is easy monetary policy. Especially we hear a lot about quantitative easing. Easy money is well known to be inflationary, and that indeed does push up the price of gold. We'll see that in a moment. But in Washington, they say low interest rates and easy money are a stimulus to the economy. Well, once again, the historical facts suggest otherwise. And the next slide shows that, dividing decades in the last 80 years between those in which the Fed produced more money and bank reserves grew faster from the decades in which the Fed produced less money and bank reserves grew slower. And I've separated World War II out because, of course, we had a lot of growth in World War II for completely different reasons. Except during World War II, then, the economy grew slower when the Fed created more money. As everyone knows, the next several years promise lots more of both of these so-called stimuli, deficit spending and easy money. So intensified stagflation is very much in the cards. Well, the rest of my charts concern how different investments cope with stagflation. It goes without saying that the investment assets that make the most sense in normal times are not the same as those that make sense under stagflation. Let me explain how to classify the economic environment into four possible scenarios, one of which is stagflation. And to do that, as a market signal of weak forthcoming economic growth, I use credit spreads in the bond market. If spreads have narrowed from the year before, the economy is going to accelerate, and then riskier assets look attractive. But if spreads have widened significantly, the economy will always stagnate or head down, and that favors safe assets. So going back to gold, that can be up or down, meaning inflation up or inflation down. Spreads can be wider or narrower, and we have four possible combinations. The interesting point is that each scenario favors a different asset class. Take bonds first in the next slide. They're an investment that does better in lower growth, but you can see that a rise in the price of gold hurts them. Next, equities. They take a double hit when growth is weak and inflation is strong. And the next slide shows equities do best in the opposite conditions where gold and spreads are both down. The third asset class I'd like to look at is commodities. Like equities, commodities are promoted by accelerating growth. And the next slide shows they do well when gold does well, but they don't do well when spreads have widened, which is when gold does best. That means that stagflation is not the best scenario for commodities either. So now let me show you that gold itself, along perhaps with the other precious metals, is the winning asset class when stagflation does come along. This final slide puts together the results for all these four assets, including gold, and it shows in which scenario and how well each of the four assets performs the best. We have a 2x2 matrix in which the four scenarios correspond to the four quadrants of the diagram. Northwest, where bonds do best; northeast, where gold does best; southeast, where commodities do best; and southwest, where equities do best. Now the stagflation scenario is the one in the northeast, and that is where gold has already been rising in the past and spreads have widened. It's also a quadrant in which gold is going to perform very well in the future as well. So the bar charts show that's where gold produces the higher returns, and in the opposite conditions, gold produces its worst performance. And at that point, I'd like to turn the mic back to the presenter.
Thanks very much, David. I appreciate your comments. And at this particular juncture, I would like to, in turn, pass the microphone over to Mr. Mark Farmer, who will talk a little bit about gold from the perspective of Bullion Management Group.
Thanks, Lance, very much. And David, it's always interesting watching your detailed analysis of what's the truth. Anyway, my name is Mark Farmer. I just want to introduce myself. I'm with Bullion Management Group. I'm, as was mentioned, VP Business Development globally. And it's been a heck of a ride over the last couple of years. I just want to talk about Bullion Management Group for a little second. We've been in business since 1998. We're a full-service precious metals provider based in Toronto, Canada. BMG offers two types of precious metals investments. The first is a direct physical bullion bar ownership, which is called BMG Bullion Bars Program. The second products are two registered open-ended mutual fund trusts here in Canada. One called the BMG Gold Bullion Fund, which is a gold-only fund, and the other one is a tri-metal bullion fund. Equal proportions of gold, silver, and platinum are purchased on a daily basis. BMG deals only in certified industry good delivery standards, precious metals, gold, silver, and platinum bullion. This is very important for liquidity. BMG deals exclusively with the Bank of Nova Scotia for the acquisition and storage of our physical precious metals. We have three vaults, one in Toronto, Canada, owned by the Bank of Nova Scotia, as well as the one owned by the Bank of Nova Scotia also in New York, and an affiliate vault owned in Hong Kong, directed through the Bank of Nova Scotia. I just want to bring to your attention a quote that came out about 40 years ago from Alan Greenspan. I like it so much. He's almost a walking contradiction for me. But what he's given us here is the truth. It was written 40 years ago, and he actually verified it this August in another interview that I read, him confirming exactly what he says here. In the absence of the gold standard, there is no way to protect savings from confiscation through inflation. Deficit spending is simply a scheme for the confiscation of wealth. Gold stands in the way of this insidious process. Well said, Alan. I just want to give you a bit of a rundown on the global macroeconomic snapshot very quickly. Were you aware of the fact that 93% of the world markets are correlated, which means if you get a little hurt on one side, you're more than likely going to get a lot of hurt everywhere. The U.S., surprisingly, for the first time ever, its debt was downgraded to AA+ by Moody's the first time in history, and then it was followed by a blanket municipal bond downgrade. Both the U.S. and the Euro banks are being downgraded, Wells Fargo, BAC, Citi, Dexia, SocGen. And if you don't change your dial, you're going to see that there's an awful lot more to come. Currently, 16.7% of Americans are under or unemployed, and 46 plus million Americans are on food stamps. This goes back to the Great Depression. Housing prices continue to decline, and mortgage lending standards have tightened. So it's harder to get a mortgage on your house these days, even if you're credit worthy. Discretionary spending is dropping as inflation eats away at disposable income. You know, discretionary spending represents 70% of the U.S. GDP. Consumer Sentiment Index for July from the University of Michigan fell to the lowest level since March of 2009 and is now back in territory normally associated with recession. All leading economic indicators are rolling over. We stand between a rock and a hard place at this moment. We've had QE1, we've had QE2, there's talk about QE3, we have problems across the pond. It's really QE to infinity. Everybody's printing, the US is, the EU is, everybody is globally. We've got an economic slowdown in emerging economies, including an acute heightened inflation prognostication coming from both India and Japan, Russia, some of these countries that have been the developing countries. We've got chronic high unemployment in the EU as well as the US and the UK. We have a number of insolvent banks, but we just don't know because of the FASB Mark II model illusion. This is something that is hiding the truth, basically. We have an austerity program implementation in several places, and it always equals social unrest. We have Greece, we have the UK, we have the Middle East, and I put here as the U.S. next, but you know, I'm just watching what's happening on Wall Street, and with the unions coming in support of their protest, who knows? We have the rising price of crude oil. We have goods and services that are going up that reduce discretionary spending. Everyone's printing money to stimulate exports. The bottom line, there's too much debt in the financial system. Here's just an example of the EU debt contagion. We're hearing about that this week and last week, especially with Greece. You'll notice here the size of the bubble of Greece relative to some of the bigger bubbles in the EU, but they stand at a debt to GDP ratio of 160%. Now, a lot of the other countries are not as exposed as Greece at this point until you look up to Italy because of the size of its bubble, as well as the fact that it's probably running in the 118%. Hey, this is the U.S. We're now a debtor nation. We're looking at the total U.S. debt, including unfunded liabilities, at about 57 trillion. That's 57,000 billions dollars. And then we're looking at a national income, this is based on 210 figures, of about 12 trillion. This doesn't look good. Just in case anybody out there wanted to see what the image was of a trillion, here's a bunch of $100 bills stacked. And it's only $100 bills, and this is $1 trillion. I want you to keep in mind that the current deficit in the U.S. is about 14.8 trillion on its way to 20 trillion by 2015 as projected. Just stack that box there 20 times over and you'll get a picture of what that means. Well, what's the economic outcome of these trends? Well, it's lower GDP, it's lower tax revenue, it's higher trade deficits, high systemic unemployment, and I know that everybody's watching Obama trying to get out of this one, but it's going to be a toughie. We've got increasing money supply resulting in declining currency value due to rising inflation. Bottom line, we're going for higher gold prices. Inflation, well, David has spoken about this, but I wanted to put up Webster's Dictionary 1983 definition, and I use 1983 because in the latest two editions they've changed the definition to drop the first part of the sentence, which says inflation is an increase in the amount of currency in circulation, resulting in a relative sharp and sudden fall in its value and a rise in the prices of goods and services. No longer do we address in the definition with Webster's the amount of currency in circulation. Printing money is inflationary. Inflation is a currency event and not an economic event. Monetary inflation always leads to price inflation, higher prices. Inflation is the result of a larger than proportionate growth in the money supply. The pain to be experienced is higher prices and a weaker economy sometime down the road. The money supply is only one of the three factors that determine whether we have inflation or deflation. The other two are velocity of money and the real output of the economy. Here's a great St. Louis adjusted monetary base for the U.S. I just liked it so much because what it did is it boxes in TARP or QE1 and QE2, and you can see the hockey stick-like formation of the money supply. Now we have smoke and mirrors CPI. Of course, I say now, it's not now. It's been around for quite a while, and David Renson has also addressed this. Gold is a stable economic measure and a reliable standard by which to measure real inflation. Governments manipulate inflation figures to keep the official consumer price index, or CPI, artificially low, since the slightest rise can translate into billions of dollars in government-indexed pension payments to the growing number of baby boomer retirees. Today, instead of using a fixed basket of goods that represents a certain standard of living, methods such as substitution, hedonic adjustments, and geometric weighting are used to understate the CPI. For instance, John Williams of shadowstats.com calculates the CPI using the original methodology. His figures show that the real inflation is already at 11% today and climbing, since the CPI has an inverse relationship with the GDP. Understating the CPI automatically overstates the GDP. This can turn into a mess. Here's a chart of the CPI calculation from John Williams in blue on top and the BLS on the bottom. You can see there's quite a drift in the figures that are being represented. These are the solid gold rules. Golden rule number 1, gold is money, not a commodity. Gold trades on the currency desk of the major banks and brokerage houses, not the commodities desk. Central banks have always regarded gold as money, yet many investors today view it as an ordinary commodity like pork bellies. Because none of the world's currencies are backed by gold, it's become the anti-currency, the money of last resort. Since 2010, central banks have become net buyers of gold. Here's just an example of China's gold reserves over the last few years. You'll recall that last year there was an announcement from China. They'd increased their reserves over a period of time without telling anybody by 400 tons. Well, we know for sure they're doing that, especially in this little dip here that we're having. Golden rule number 2, gold does not rise. Currencies lose purchasing power against gold. Major currencies have lost more than 70% of their purchasing power against gold over the last 10 years. 70% over 10 years. Not until we begin asking, how many ounces of gold will this cost, rather than how many dollars will this cost, will the proper perspective be in place. Here's a chart that just gives you an example of some of the major, or 5 of the major global currencies, and how since 2001 they've lost their purchasing power. Golden rule number 3, gold has intrinsic value because it is difficult to find, to mine, and to refine. In Roman times, an ounce of gold would buy a good suit of clothes. Today, the same applies. And this chart just shows you really quickly a couple of items priced in ounces of gold. Back in 71, compact car, 66 ounces of gold. Today, 9. And as you can see, the housing, and this is based on Canadian housing prices, by the way, because we have a National Housing Association that measures this. Cost 703 ounces in 71, 221 today. Dow Jones, 25 ounces, and depending on what day you're looking at it, today it costs you 7.5 ounces. Golden rule 4, gold's a wealth-preserving asset, not a wealth-accumulating asset. We buy and hold gold bullion to preserve wealth. We may speculate in gold stocks, exchange-traded funds, futures, and options to increase wealth, but gold bullion ownership best serves the purpose of wealth preservation. This has been the case for thousands of years, about 5,000 years to be exact, and will continue to be so unless governments discover a way to produce gold out of thin air as they do fiat currencies. Portfolio diversification. Well, you need gold for proper portfolio diversification. Without it, you don't have it. Diversification is one of two general techniques for reducing investment risk. The other is hedging. Here's a sample of a precious metals investment pyramid that allows you to diversify into different classes of assets. You'll notice at the very bottom, the foundation is where you find hard currencies and physical gold bullion. As you move up the pyramid, you increase in risk, but also in potential yield. And so you're increasing the liquidity as you move towards the bottom of that pyramid. This may be a surprise to some people, but have a look at some of those categories from the standpoint of the risk. Hedging with negative correlation. Well, this chart was done by Ibbotson and Associates back in 2005. However, it covered a long period of time, 1972 to 2004, and what it shows you is that gold is the most negatively correlated asset to all other asset classes. And one needs negative correlation to have a properly balanced and diversified portfolio. When should I be in precious metals? Well, the Dow Gold ratio tells you when. It's been pretty reliable and very simple to follow. When the Dow Gold ratio is going up, it's time to be in financial assets. When it's going down, it's time to be out of those financial assets and into gold. And so as you can see, we've moved into several different periods through which it was time to be buying financial assets. And if you look to the right, that's us now. It's time to be in gold. We currently have a ratio. Actually, that ratio is a little inaccurate with the recent movement in the prices over the last week, but we're darn close. It's probably in the 7 to 7.25 range today. It's probably going to end up at 1. Here's just another version of demonstrating to you that compared to some of the paper assets out there, bonds and indices, gold is in a secular bull market. Again, this is a different way of charting that. The top 3 lines are gold, silver, and platinum as compared to the S&P, the Dow Jones, and the Toronto Stock Index. Gold inflation adjusted high. Well, most people will say, gosh, gold is too high. Adjusted for inflation using the CPI deflator, gold would have to be $2,300 an ounce today to match its high of 1980. If you were going to go to Shadow Stats and ask John Williams to use his deflator, gold today would have to be at US dollar $7,000 an ounce. Above ground gold distribution, just in case you didn't know, this is CPM statistics. Approximately all the gold that's ever been mined still remains above ground. We've got about 165,000 tons. What I bring your attention to is the official sector for monetary gold and the private sector for monetary gold. So the official sector, which really is the central banks, have just about 29,000 tons of gold in their reserves. And as I said, they turn to net buyers. The private investor has got about 29,600 tons of gold available to him. All of the rest is commodities gold or industrial gold, and it doesn't really fit in the scenario for investing into bullion. The total assets of the world are approximately $200 trillion. And what I've done is I've just pulled out the monetary gold that's in there and showed you the $1.5 trillion worth of central bank holdings, the $1.5 trillion worth of privately held gold. By the way, that privately held gold splits out amongst some of the wealthiest families in the world. We're never going to let it go. We estimate there's about $700 billion in liquid gold available to be purchased from an investment standpoint. So if only 20% of that 212 trillion, or even 10% for gosh sake, take a look at that. They'd have to be trying to get into 1.5 trillion of privately held gold one way or the other. That's all I have to say about that. You know exactly what I'm saying about where the price of gold is going. It may not quite be there yet, but it sure has come nicely. We've averaged probably around 17 or 18% per annum on precious metals gold bullion over the last 10 years. We're in a secular bull market. Gold is the money of kings. Silver is the money of gentlemen. Barter is the money of peasants, but debt is the money of slaves. I thank you very much for your time, and I'll hand over to Lance Roberts.
Well, thanks very much, Mark. What I would like to do now for timing purposes for everybody, if you'll flip it over to me, I'd like to open it up for questions from the audience. I already have several that have been submitted, and what I would like to do is to develop these for both of, for all three of us, if that is conceivable. First of all, Mark, because I'm still fascinated by your presentation, but my question here is, by holding only precious metals bullion, which mutual funds are not allowed to do, what are the primary differences in the Alliance Trust Company funds as opposed to what I see oftentimes in the marketplace with advisors, GLD, SLV, or other ETF products of this nature? That's a question for Mark.
Thank you, Lance. Well, basically, if you're dealing in GLD, I don't know if you saw that risk pyramid, but all of the ETFs sit much higher on the risk pyramid than does precious metals bullion, very simply because it is still a derivative of bullion. Now, the ETFs are quite young. They're only about, since 2004, I believe it was, GLD came in, and SLV, it was even a younger period that we've had exposure to these. We here at BMG have done an awful lot of research on ETFs, and we've discovered that there are some questionable disclosure practices, as well as questionable title, if you will, as to who actually owns the bullion. It would seem that some of these ETFs can actually lease the bullion from central banks and don't actually own it when they turn it in for a basket of shares. What we're looking at is something down the road that's got some cracks in it that we may not have seen yet, but that are about to happen. Whereas physical precious metals bullion has been around for about 5,000 years, 3,000 years used as currency, and it's been a preserver of wealth. I think ETFs are great to trade, but I would never look to preserving my wealth in a derivative of bullion.
Well, thank you very much. This kind of correlates with the next question. And this is, do you feel that these unique collective investment funds are more advantageous from a standpoint of diversification, inflation, or stagflation hedge, or all of the above? And let me refer that to David. I'll repeat it, David. Do you feel that these unique collective investment funds are more advantageous from a standpoint of diversification, inflation, or stagflation hedge, or all of the above?
Yes, all of the above. Gold and precious metals perform best in the diagram that I had in my presentation, the northeast quadrant, and that represents a stagflationary economy, whereas equities perform best in the opposite quadrant and the opposite economic conditions. So for that reason, the correlation between returns from equities and returns from gold is strongly inverse, and it means a great deal of diversification.
Thank you, David. I received another question from a fiduciary perspective that I think I can probably handle, and that is, what's your opinion in terms of prudence in offering or not offering gold, silver, platinum, specifically the ATC funds, to plan participants, retirement plan participants, as an investment option in 401k plans? And I think that that's probably, from an advisor perspective, one of the most important considerations in terms of using products like this is, on first blush, in talking to different advisors, I find oftentimes that they are concerned about the fiduciary liability of offering money, if you would, or precious metals as compared to the more traditional investment options of equity bonds and those types of style boxes. But if in effect a lot of the graphs that you guys had talked about today and the relative performance of gold over the last 10 years repeats itself over the next 10-year cycle, here isn't it time that these advisors and these fiduciaries ought to consider their potential liability of not offering this option to plan participants, which I think is a very important consideration in light of inflation or stagflation problems. And another question here is, would your answer be any different pertaining to asset allocations for defined benefit plans, endowments, or foundations? I'm more likely to find gold holdings on the part of consultants in those types of venues, defined benefit plans, endowments, foundations, and also I would add in fund-to-fund options that it becomes one of the core holdings within those fund-to-fund programs, so that in many cases the consultants who primarily provide service to the large plan or the large retirement plan, foundation, or endowment market are utilizing this product, and I think it's part of the challenge of ATC to bring this product into the small plan retirement base. Lastly, David, can you give us your opinion why precious metals like bullion and therefore the ATC funds offer prudent correlation pertaining to portfolio diversification?
Yes, it's the same basic question. Gold performs best under the circumstances that we're probably in the economy, and this is the very set of circumstances in which equities perform the worst. And the same thing is partially true for bonds and even for commodities. Commodities are favored by one factor, that is the depreciation in the dollar, but they're not favored by the rising risk shown in yield spreads and in the slowing of the economy. Debt or high-grade bonds are favored by the slowing of the economy, but they are definitely hurt by a rise in the price of gold, sometimes quickly and sometimes much more slowly. So none of those three assets, commodities, equities, or bonds, provides the protection that in the current environment that gold does. They all produce subnormal or even poor returns under those circumstances, which gives you the negative correlation shown in one of Mark Furman's graphs between gold and all the other assets collectively. So gold provides excellent diversification to any portfolio that contains the conventional asset classes or even the conventional asset classes with commodities included.
Mark, it's obvious from your presentation you're not afraid to venture into any particular rough waters, and I noted in some of these several discussions by the political candidates looking to become the president of the country that several of them have characterized Social Security as a Ponzi scheme. Based on a recommendation by your office, I had an opportunity to read the book Endgame by Mr. Malden, and one of his contentions in one of the conundrums that a lot of advisors are faced with in this current economy and market is that for downside protection, they're left with the use of treasuries or stable value funds or low duration cash products that rely heavily on treasuries. And the consensus, at least in terms of the book, was that in many instances the government is engaged in actively attempting to get a lot of different plan participants to invest in treasuries. There's even been some talk at the federal level of making investment in government treasuries the only option available to 401k plans. But might one also conjecture here that in terms of the use of a term like Ponzi scheme, where government attempts to encourage plan participants to invest in treasuries and at the same time period engages in monetary activities that are intended primarily to encourage inflation and the destruction of the returns and the negative returns in those same treasuries that they're trying to promote. That may be a long-winded question, but I'd love to get your comments about it.
Well, thank you. Of course, I've been following this as everyone else has. I've seen there's two camps there. There's a couple of people on one side that believe that it's not a Ponzi scheme, that it's legit, that it's going to exist. As the median baby boomer moves into the retirement phase, my understanding of it, and I don't pretend to really have an excellent understanding of the whole system, except that my understanding is that the government has got their hands in the cookie jar and has left a whole bunch of IOUs, and when you and I come to collect, we're not quite there yet. Well, there just may not be enough of a return in treasuries, given that we feel that way too much money has been printed to be able to get out of it, basically. So I think it's going to be a losing proposition. Not sure if I go the exact route of the Ponzi scheme, but I do believe that anything related to U.S. treasuries is going to hurt dramatically over the next few years, given the mismanagement, I guess you'd say both in a monetary sense and a fiscal sense. And it's moving globally, so it's not just the fact that the U.S. has got some problems, the EU's got some problems. My view of this is you can't put out a fire by throwing gasoline on it, and it seems to be the only thing they know how to do. I don't know if that answers it, Lance.
David, Mark, thanks so much for being with us today and sharing. And thanks, everybody, for participating in this communication. I hope it was enlightening, and I look forward to feedback from all of you in terms of questions that could be forwarded to the address, the phone number, and the email address referenced. Again, thanks, everybody, and everybody have a good weekend if we don't chat in the interim. Bye-bye.
Thank you.
Bye-bye now.